Welcome. As part of the Agricultural Industry Group at FCW, we've got today James Price, the Managing Director of JPA Business. I got it right, James?
Yeah,
it wasn't too bad, was it?
Yeah.
James works across a lot of industry, but has a real specialisation in agriculture and food processing.
Correct, yeah.
And creates wise and thoughtful methods of valuing and helping businesses go through various types of transition. So we'll talk more about what James does in a few minutes' time, but I thought let's get to the heart of what's going on in where you and I both work, which is in agriculture.
A lot happening in that space, right?
And we've seen a significant change, James, in the demographic of farming communities, haven't we?
Big change over the last, well, probably 2 up to 3 decades.
Yeah.
You know, huge move to corporate agriculture, I'd have to say, and also larger family farm units.
We've certainly seen a move away from farmers as a trustee of property for future generations who are not really looking at a return on capital. They're looking at holding on to something that's precious and owned in a family for all people in a family, to people who are trying to realise capital at rates of 8 to 10% rather than 2%.
That's right. Commercial rates of return, in other words.
Yeah, and we're seeing a real change in the single-use farming. You know, the farmer used to be just do fat lambs.
And that's all they do. And then it'd move to the next generation.
Yeah. So what do you think the major changes are? Look, let's first of all talk about the size of farms.
Well, I think productive farms are getting bigger, and there's a real divide between those farms. I call them, large joint partner farms or family farms, but significantly larger. They're buying up some of the smaller farms. They're increasing scale, improving efficiencies, improving productivity. They're taking much more of a role in terms of their own marketing than previously.
Which is a fascinating change, isn't it? Because, the first parts you've talked about are the growth and development of technology in farming, the understanding of markets, the understanding of climate, the more predictive methods of farming, which were not part of the historical method of farming, which is I farm lambs, I farm cattle.
Well, and almost I produce something, and when it leaves the farm gate, someone else can take control of it for me and markets it for me.
But that's the next really big change, isn't it? Is actually being a consumer in its own market.
Absolutely.
Yeah, when we look at how people actually sell, so there's farmers, and some farmers have been crushed by the sort of oligopoly of the Woolworths and the Coles, who have driven prices down to such a low level. But smart farmers aren't doing that, are they? They're looking externally, they're looking overseas, they're looking at different markets.
Well, exactly, and they're wanting to interface direct to the market. I mean, we've recently done an assignment with a large agribusiness in WA, and their clients are grain farmers. And to talk about the demographic of those grain farmers, a lot of those grain farmers are linked up with customers in Asia for their product. And 10, 15 years ago, when there were regulations involved and still in place and large monopoly bodies doing the marketing of grain, there were none of those relationships.
Right.
So those farmers need to be astute in terms of understanding the quality of the product right through the supply chain.
Which is a change in Australian production, isn't it? Because quality 20 years ago on farms, if we look at, let's be a bit tough, we look at businesses like Murray Goulburn, who produced milk and produced, what was the milk value. Their difficulty was they were not able to produce the level of quality for when other dairy-based businesses came into Australia.
That's right.
And now we're seeing the same transition in farming to sort of high-quality farming, building off the green credentials of Australia into the overseas market.
Well, and there's a couple of parameters to make these farms successful in terms of return. One is quality and being able to tap into those customer markets to get a premium.
Yes.
And the other is scale at the farm level. Be able to have enough scale to produce whatever they're producing in an efficient, cost-effective manner. And unfortunately, there's a rump of smaller farms at the bottom end that aren't able to deliver on either of those parts very easily.
And aren't vertically integrated. They have no logistics, they have no silo capacity, they have nothing which allows their capacity to actually trade.
That's correct.
They have to get it out the door.
Yeah, that's correct. And look, it reminds me of an analogy. If I just step out of farming and go into the construction sector, we deal with quite a few clients that are in the civil earth moving sort of business. So if you think of a subdivision, land subdivision, the really successful ones are the ones that control not just the trench diggers, but they control, the road base, they control the product coming in as fill, they control the electrical wires. So they're not reliant on each of those parties at their own time and agenda to come and play in their project. They can pull those streams and influence that to affect their efficiency.
And create a transfer pricing mechanism so they can actually build value along the way.
That's right. So if you go back to the agribusiness supply chain, absolutely critical. And if you think of some of the risks, we've talked before about climate change being a real complexity, right, to farming in terms of drought and other unfavourable weather conditions. But also, food by nature is can't always be stored for months on end. It spoils. So, it's got its own inherent risks, but being able to control and influence that supply chain right the way through allows some of those risks to be managed more effectively. And the return, invariably over the longer term, should rise as a result.
It's funny, isn't it? When you're outside of Australia, you can buy beautiful Australian soft fruit, but you can't buy it here because the buyers here buy at a market rate which fits the supermarkets.
Yes.
So when I was in China, I was buying these amazing Australian peaches, and I was chatting with my friend there. Where do they get these? He said, it's Australian. No, it is Australian. They only sell to China. That's the difference.
Yeah.
So the drivers of change in agriculture are size, volume, to create proper margin. They are market understanding, climate understanding.
Yeah.
But it's also an understanding of debt and tax, isn't it? Because that's one of the big changes that's come through.
Well, it's the old thing, I go back to my banking days, right? And, bankers have always lent money in agriculture because of the asset. They always thought the asset would appreciate, and security-wise, they always had coverage, right?
Yep.
But over the years, it's not just security that's important, it's also debt servicing. And unfortunately, at a low return that's been traditional in farming previously, 2-3%, servicing isn't crash hot. And therefore, some people that were highly leveraged found it difficult to get finance as a result. Now, I feel the current changes that we've spoken about is really swinging it round to focus on servicing. It's focusing on cash flow, cash generation, surplus cash, being able to invest those earnings back into the business model to grow it further. And unless a farm has surplus cash, is generating surplus cash, and has those earnings and can demonstrate that serviceability, is going to find it hard to fund the growth of their operation.
It's part of the vice of the taxation averaging system, isn't it? That it brought about a cash complacency.
Correct.
Because we don't have it in our industry. I'm paying my tax. There's no cash complacency in my business.
And it's a peculiarity that's allowed a lot of farms to exist, even when they've been really underlying delivering negative returns.
Yeah.
Right? And that's perpetuated families to stay on the farm, but actually, fundamentally, it's not a good sort of health factor, we would say, from a valuation perspective, in terms of looking at the strength and sustainability of a business moving forward.
Yes.
Right?
What I want to do is, let's talk about the hard part in farming. So we've talked about what a farm is, we've talked about the changes, but it involves people. And part of the problems with farming, particularly family or partnership driven, and the more cooperative practice that exists in the larger grain-based farming, where there is a shared supply chain methodology that exists between a group of them, is what happens as people grow old? What happens as sons go to university, daughters don't want to be on a farm, they marry someone who's a pharmacist who's not a farmer? Those things were managed in a very binary way 30 years ago. The eldest son took the farm. That's right. That was it. and there was not much else left behind. That's not the case now, but the discussions that start around succession are the hardest, aren't they?
Well, they are. I mean, I've seen many a client, and the younger generation gets to take full financial and physical control of the farm in their 60s. And you think to yourself, why is that good for agriculture, let alone the individual and the business? You know, if I've got to wait until I'm in my 60s to actually take the risk and fully, feel the return, right? And that's because the hard discussion is put off, or it's assumed. Oh yeah, we'll run the farm, and in the meantime, this is the deal. But it's not talked about openly, and it's maybe it's a little bit complex because there might be one or more siblings involved. But those hard decisions are often put on the back burner.
And part of that's historical because they weren't profitable, so it was sweat equity.
Correct.
But now we're seeing ones which are not only profitable, but going to be much more profitable as market understanding, climate, the more predictive technology is used in it. It's time to get in early with these conversations, isn't it?
Oh, look, like any commercial business, if you go in a business with someone and it's more than just an employed position, there needs to be some work done up front.
So let's talk about what you do, because that sort of brings in your involvement. It's not just in valuing, but when someone brings you into the business, James, and they're saying, look, I've got 2 sons, a daughter, I've got a cooperative arrangement with 3 other farmers, we own 2 trucks together, we have silos. What do you do?
Well, look, oftentimes we come in to value the business, and it's not necessarily because they want to sell the business, but they, some of the forward-looking farmers are now saying, what's the value of our business? Have we got sustainable earnings? What is our supply chain like? What is our market customer base like? Where are the risks associated with what we're doing? And how do the people and our people fit into that? And so typically we'll come in and provide a view, an independent view about the value of the business and how sustainable the earnings are. And then at oftentimes, I'd have to say mostly too late, but that's a personal view. There's a discussion about generation transfer, and there might be a mother, father, 2 brothers, maybe 3 brothers in a large farming exercise, and they're in their 60s, and there's a couple of siblings that are wanting to stay in the farm to be transferred, but others are wanting to be moved out, right? And so the older generation are saying, well, it's about time we sorted this out and got some clarity around a value transfer. The younger ones are saying, well, hold on, if we're going to come into this business, what's the return? What sort of a return can we make? How much risk can we take in coming in? And how much capital do we need to grow it to the next stage? So an independent valuation and a view about the sustainability of earnings helps those decisions. It's simply decision support. I mean, every valuation is wrong from the moment it's done, because everyone has a different view on value because of their risk appetite. But it provides a basis for discussions around some of these key issues.
And James, for us, when we're asked to come in and advise around succession and look at estate planning, I must say the first thing I do is, well, look, before we start this, can we get a valuation? Yeah. And everyone looks at me and goes, well, that's just spending money. And I go, well, you're going to go buy a car, but you're not allowed to see what it looks like. You're not allowed to look under the engine. You're just going to buy a car. Would you do it? And the answer is, when we're going to talk about the future of generations, we should be candid.
Yeah.
We should tell them the truth. And the other part is this new life coming into the business will want to make decisions based on their risk appetite, and they've got to know what the tools they're using. So to me, the valuation is a window into making decisions. It's a critical window, you're right, it's imperfect. But what it does do is it captures 3 things. It captures true capital value, it captures true economic performance of it.
Correct.
And it paints a risk picture. Now those 3 things tell you, okay, here's the first 2, capital, economic performance. okay, these risk factors are the variables that you can start moving. I want higher return. Well, if I do that, what will happen?
Yeah, that's right.
Where does it do it? And it allows people then to make informed decisions. So you might have two rash sons in a property that has great returns, but if they move up the risk variables, everything going to be lost.
That's right.
So I think it's one of the reasons we work with James is to say, look, please get this part right. But what you do, which is really clever, is actually the next part, James. The valuation is part of it, but now you've got that. You've got a family and a group of people who are struggling to make decisions.
Well, the interesting thing is, because we provide an independent view of value, it's the elephant in the room. Even though, as you say, it's quite often, well, why would we do that? Why would we spend money on that? But it's the elephant in the room, and no one wants to really nominate the value because they've been part of a family, right? So commercially, it's more than just value. But the independent value on the table allows us to have a structured discussion about people's aspirations and the commerciality around making a decision to invest, stay, or go.
Yeah.
And as a result, the next part is really facilitating that to a point where there's a future track of ownership for the business.
And can I just say, it releases mum and dad. It allows them to live a standard of life without being just a roustabout who gets paid nothing and has nothing, to having something that is real and tangible for which they can make decisions about themselves separately. I think that's a really important part, and that's what kills mums and dads. They're sitting there going, I'm about to hand over $20 million of assets. When I hand over, I have nothing. I'm a shareholder, but it's nothing. I'm a director, but it's nothing. What's my liquid cash? Can I go overseas next year without asking my son?
Exactly. And I've got countless clients. I know of one in South Australia. The father's dead, the mother's in her 90s. The next generation are in their late 50s. There's on the father's side, there's other siblings still involved in the ownership. They're in their late 80s. And none of these discussions have been had.
Yeah.
Right? And you think to yourself, well, hold on, they're just putting themselves on ice.
They are.
Right? But now we've got commercial, strong returning businesses with a lot of upside in the next few decades as Asia becomes a powerhouse for demand around food. And we're sort of putting an investment on ice. I mean, it doesn't make sense, right? If you had a share portfolio and you were managing it yourself and you thought there was a better return over here, or you were worried about that risk at a point in time, you would unload it. Or you'd have a strategy for how you deal with it, even if it was a longer term investment.
Yeah.
And the same is true for agriculture.
Don't know about you, James, but I work because I have children. I work because I love work. But part of my happiness is knowing that I'm creating safety for my children. But I don't own a farm, so I'm allowed to create happiness for myself.
Yeah.
So part of my happiness is actually also ensuring that in the times when I eventually leave law, I actually have financial independence. I can make my own decisions. I can do things. But what happens in these enclosures in farms is land means more than people.
Correct.
And it means that no one is happy.
Yeah.
That people feel they're working for nothing, but they're given this huge benefit. You've got the family trust under here, the family land, but I'm not getting anything out of it. Mum and dad, once they retire, they have nothing. They have to put their hand out and ask for money.
That's right.
Because even the money in the bank is the land. So
yeah.
We've got to step this discussion up a level, don't we? We really have to start saying, if you really love someone, be honest with them.
Well, and straight up.
Yeah.
Look, this is the return. This is what it's generating. This is the potential. And this is the sustainability of the earnings today. These are the risks. What are the various parties' aspirations? Where are
and
they?
Their capability. The other issue is,
can they run it?
Can they run it? When we look at historically successful businesses, sometimes the dad and mum were the very successful people. Sometimes it's the next generation through who are enlightened and took something simple. Pratt family is an example of
Perfect.
the son coming through and expanding the business. But my point about all that is you never plan a business that's not built around capability, because it is fatal.
Yep. Yep.
So part of this terrible conversation you're going to have is saying to some members of the family, this is not your skill.
Well, I had that discussion just recently with an agribusiness client that's got farming and also quarrying interests. And one of their sons has got great expertise around running a certain part of the operation. And essentially, he wants to bring forward the succession and the ownership and transfer. And we had a detailed discussion with the facts and figures, looking at his capability, look at the others in the family, looking at the older members, older generations' aspirations and plans for the future, looking at what the business was returning. And the end result was, young Johnny needs to stay managing the business and we'll agree a track to ownership, but it's too risky to have someone with his capability taking ownership right now, because it's not going to deliver the return sufficient, to meet the expectations of the older generation. So it's working through that decision support carefully and with clarity, and not dying wondering. So having the hard discussions, as you pointed out.
And look, this is why we come to you, James. So as lawyers, we're great at documenting the back end of it. We're not bad at starting some of the tough discussions, but we don't have your knowledge, we don't have your financial acumen, we don't have your life knowledge of agriculture that allows you to say those things. So the reason James is here today is to say there is a pathway through this process, but it does involve always at the beginning knowing the true three things. What is the financial performance? What is the capital value? What is the risk paradigm that you're working within?
Correct.
And then applying it against the people who have ownership or potential ownership and saying, what is the options based on risk you can have, but those conversations have to happen early.
They have to happen early, and it sounds difficult, and some of them are difficult conversations and processes. But if they're done with facts and independent analysis and robust decision support, in my estimation, many of the outcomes can be very positive, and particularly where they're supported by strong practical documentation, because then everyone's clear about the situation moving forward. And we know ourselves as individuals. If we know things up front, we can be very focused and deliver valuable things, whatever we're doing. So it's there is a way through, and it's going to be more and more important as these agribusinesses grow and become very successful businesses.
And I think, James, just on our last point, and then we'll close up on it, is that what James said is, at the end of this process, this is a James process, not an Andrew process, of actually building what that succession plan looks like. The documents must not be complicated. They must be simple. They must be a guide for future behaviour.
Correct.
Because without that, what happens is only the articulate, often only the angry one, actually goes and looks at them. What we need is a story that is told with clarity, where decision responsibility is clear and where the journey is clear. Without that, everything blows up.
Yep, that's exactly right. And look, if the work's done well and the assessment's done well and the parties are carefully respected and involved, mostly they'll come on board.
All right, James. Thanks very much.
Thanks,
Great to have you along. Cheers.
Pleasure.
Bye-bye.